Here is something that sounds wrong but is true for lakhs of families. A family of 4 can hold a rupees 2 crore term insurance policy and still be underinsured. Not because the number is small, but because it all rests on one name. Most cover calculations are built around one person, one income, one number. A family of 4 does not work that way. There are 2 incomes or one income carrying 4 people. 2 children whose big expenses arrive in different years, usually an EMI. So if you have been asking how much life insurance you need or are searching for a term insurance plan for a family of 4, the honest starting point is a household level calculation, and this video walks you through it. A family of 4 with 2 children typically needs combined term insurance cover of 12 to 15 times the primary earner's annual income, plus the full value of any outstanding home loan, plus a separate education corpus estimate for both children. And if both parents earn, each partner needs independent cover sized to their own income contribution. A corpus, by the way, is just a fund, the amount you set aside to make it grow for a goal. Nothing more technical than that. Let us build this piece by piece. Most families insure the primary earner and stop. The logic feels reasonable. Protect the highest income first, but think about what the second income actually does in your home. It may pay the school fees or half the EMI or the household running costs. If that income stopped tomorrow, none of those expenses would stop with it. The family would absorb the loss by cutting into savings, into goals, into the very plans both of you built together. This is why each earning partner needs their own policy sized to their own income contribution, not a token cover, a calculated one. If one of you earns 15 lakhs and the other 8 lakhs, both numbers deserve the same treatment. Each partner's cover is built on their own income. So either income is protected on its own terms. And if one partner is a homemaker, their contribution is not zero. It is unpriced. Childcare, the running of the home, the 100 things that make the earning partner's job possible. That work has real financial value, and a family's protection plan should account for it, whether through cover on the homemaker or a larger cover on the earning partner. Let us run a sample household. Say you and your partner both earn rupees 15 lakhs and rupees 8 lakhs a year. You have a rupees 60 lakh home loan and your children are 4 and 8. 4 inputs go into your calculation. First, income replacement for each earner built on each income separately. Second, the full outstanding home loan is added on top. Because of either income serves the EMI, either policy should be able to clear it. Third, education for each child is estimated separately. Your 8-year-old reaches college in about 9 years, your 4-year-old in about 13. So the amounts and timelines are different, and one combined guess will miss both. Fourth, anything else the household carries, a car loan or support for your own parents. Then subtract the savings and investments you already have. What remains is the household's total cover split across both partners in proportion to their incomes. Once you have your number, evaluate any plan you are considering on 4 things. 1. The claims settlement ratio. That is the percentage of death claims an insurer actually paid out of all claims it received, published every year by IRDAI for every life insurer. Look for higher percentages, consistently across recent years, not just one good year. 2. Whether the policy allows a sum assured increase at life stage events like the birth of a child or bigger home loan. For a growing family, this flexibility matters more than almost any other feature. 3. The Waiver of Premium Rider. A rider is an add-on to your base policy, and this one waives all your future premiums if a listed critical illness or permanent disability stops you from paying while your cover stays fully active. For a household with an EMI and 2 children, it protects the household itself. 4. Structure. A joint policy covers both partners under one contract. While 2 separate policies can each be sized and topped up independently as each partner's income grows, for most dual income families, the flexibility of separate policies fits better. But your household structure decides. Cover for a family is not a one-time purchase. it is a number you revisit. 4 triggers should always send you back to the calculation: a new child, a home loan increase or refinance, a significant income jump for either partner, and your children entering their higher education years, when the education fund stops being an estimate and becomes a bill. The question of how much life insurance I need is not asked once in a lifetime. For a family, it is asked at every one of these moments, and the household that reruns the number at each trigger stays protected at every stage. If you're ready to put this into practice, ABSLI's term insurance plans offer the features this framework asks for, including sum assured structuring across cover needs, life stage increase options, and riders such as waiver of premium and critical illness. Links to ABSLI Super Term Plan and ABSLI Salary Term Plan are provided in the description below. If you are about to decide on this, here are 3 questions worth keeping in mind. Should both parents in a family of 4 have separate term insurance policies? Yes, if both parents are earning, each should have independent cover sized to their own income contribution. Even if one parent earns less or is a homemaker, their economic contribution to the household, including childcare and home management, has a financial value that should be factored into the family's overall protection plan. How does having 2 children change the term insurance calculation compared to 1 child? 2 children typically require separate education corpus estimates, since each child will reach major education milestones at different times and costs vary by chosen field of study. A family should estimate the future cost for each child individually rather than using a single combined figure, since the timing and amount can differ significantly. Is it better to buy a joint term insurance policy or 2 individual policies for both parents? Both options are available in India, but they serve different needs. A joint policy covers both partners under a single contract, while 2 individual policies give each parent an independent cover. Separate policies generally offer greater flexibility to customize the sum assured, policy term, and future changes based on each person's income, liabilities, and responsibilities. The right choice ultimately depends on the family's financial needs and the specific features of the policy. A family of 4 is not one financial life. It is 4 lives woven together, and the plan that protects it has to see all 4. Run the household calculation, cover both earners, and put the review triggers in your calendar. If this helped, like the video, subscribe, and check the description for ABSLI term plan details. Because for a family like yours, how much life insurance do I need is a question you now know how to answer properly.